In today's video, we are going to talk about two important aspects of trading: leverage and margin. Leverage and margin are two important terms that are often discussed in the world of Forex trading. Both leverage and margin allow traders to increase their exposure to the market, but they work in different ways and have different implications for traders. In this article, we will explore leverage and margin in detail, explaining how they work and how they can be used in Forex trading. What is leverage in Forex trading? Leverage is a tool that allows traders to control a large amount of capital using a relatively small amount of their own money or margin. Leverage is expressed as a ratio, such as 50 to 1 or 200 to 1, which means that the trader is able to control $50 or $200 for every $1 of their own capital. For example, if a trader has a leverage of 50 to 1 and they want to trade a position worth $50,000, they will only need to have $1,000 in their account, $50,000, 50. This means that leverage allows traders to take larger positions than they would be able to take with their own capital alone, potentially increasing their profits. However, leverage is a double-edged sword. While it can increase profits, it can also increase losses. This is because the trader is taking on a larger position than they would be able to afford with their own capital alone. If the trade goes against them, they could end up losing more money than they have in their account. What is margin in Forex trading? Margin is the amount of money that a trader must have in their account in order to open and maintain a leveraged position. When a trader opens a leveraged position, they are required to put up a certain amount of margin, which acts as a deposit and helps to cover any potential losses. For example, if a trader has a leverage of 50 to 1 and they want to trade a position worth $50,000, they will need to have $1,000 in their account as margin, $50,000, 50. This means that the trader is able to control a position worth $50,000 using only $1,000 of their own capital. Margin is usually expressed as a percentage of the total position size. For example, a margin requirement of 2% means that the trader must have 2% of the total position size in their account as margin. How to calculate leverage and margin in Forex trading? Leverage and margin are closely related, and it is important to understand how they work together. The following formulas can be used to calculate leverage and margin in Forex trading. Leverage equals position size, margin. Margin equals position size, leverage. For example, if a trader wants to open a position worth $50,000 and they have a leverage of 50 to 1, they will need to have $1,000 in their account as margin, $50,000, 50. Alternatively, if a trader wants to open a position worth $50,000 and they have a margin requirement of 2%, they will need to have $1,000 in their account as margin, $50,000 by 2%. It is important to note that different brokers offer different levels of leverage and margin requirements, so traders should carefully consider these factors when choosing a broker. In conclusion, leverage and margin are important concepts in Forex trading that allow traders to increase their exposure to the market. Leverage allows traders to control a large amount of capital using a relatively small amount of their own money, while margin is the amount of money that a trader must have in their account to open and maintain a leveraged position. Leverage and margin can be calculated using the formulas provided above, and it is important for traders to understand how they work and how they can impact their trades. However, it is also important for traders to be cautious when using leverage and margin. While they can potentially increase profits, they can also increase losses if the trade goes against the trader. It is crucial for traders to carefully manage their risk and to use leverage and margin responsibly. One way to manage risk is by using stop-loss orders, which automatically close a trade if it reaches a certain level of loss. Traders should also consider implementing a risk management plan, which outlines the amount of risk that they are willing to take on for each trade and helps them to stay within their risk tolerance. Overall, leverage and margin can be powerful tools for Forex traders, but they should be used with caution and careful risk management in order to maximize profits and minimize losses. Thanks for watching. Please don't forget to like and subscribe to my channel for more content.